Hey guys, Toby Mathis, and today we're going to dive into two write-offs that your accountant's probably missing, and it's costing you thousands of dollars. And this is specifically for real estate investors, and so I brought in an expert to explain these two things. And I'm not gonna mess around and beat around the bush. It's called Pad and Quip. And Chris Streit, this is your bailiwick. Can you explain what these are and why accountants are missing it and what it's costing those folks that when they do miss it?
Sure. Yeah. Thanks, Toby. What we're really looking at with QUIP or QIP and PAD, partial asset dispositions, these are things that happen post acquisition of a property in most cases. And when folks think cost segregation, they think I buy the property and I get a benefit, and they're correct. But that's not the end of the story. The story continues. The story continues because the property evolves and continues. You add things to that property. You remove things from that property. And if you see it as a one and done, I bought it, I deducted it, now I'm on my way, then all of these things are being missed. Pads are disposed items that get to be expensed, permanent tax savings, and QUIP, qualified improvement property, those are improvements to commercial property that get to leverage 100% bonus depreciation now that we're in post January 20th, 2025 world. All those improvements get to be bonus eligible. So major impact for the taxpayer, and they typically occur after the property is acquired.
All right, so let's go into it and make it real. So I'm a landlord, and you just threw a lot at me, and I'm sitting here thinking, like, how does this help me? Let's say that you bought a property in Indianapolis and you got to replace the roof. You've had it for 6 years. Are you telling me I can write off the entire roof that I get rid of by doing a partial asset disposition?
You can. So what that looks like from a tax standpoint is your accountant has something called a depreciation schedule for you, for your property that they use for their tax return. Whenever you buy that property, the cost of that property goes on that depreciation schedule, and it's given a life. 39 years for commercial properties and short-term rentals, 27 and a half for residential. When you add things like a new roof, that new roof shows up on there as a roof, and whatever you paid for, it's sitting there. But what you're sitting there with is your new roof and the old one that's in that initial purchase price. So you have two things sitting on your depreciation schedule that are duplicative of each other. The new roof should be there, the old roof shouldn't be. That old roof should be valued and completely 100% expensed and taken off the depreciation schedule to give the taxpayer relief.
And you get to write that off. That's just like you got rid of it, right? So like that's pure deduction.
Yes, and that's why it's referred to as a PAD or a partial asset disposition, because it's not the entire asset. See, there's a lot of things that happen with cost seg, and typically when we do one, we're all usually so focused on the tax savings that we get. But when you think about what the term stands for, it is cost segregation. You are taking what is a single asset and segregating it into multiple assets. Therefore, as a result, you can identify what's being pulled away and what's being added. Those things being pulled away are partial from the whole, from the start of the building, partial assets that are being disposed. Once they're disposed, they're gone. There's no recapture. It's an expense and it's a total write-off.
Now, does this require a cost segregation? And if the answer is yes, does it require a study, I guess?
Yeah, so it does require cost segregation. You couldn't dispose of an asset without having segregated all the assets into all the different asset classes and types and having those individual things out there. And from what we see from a cost segregation study standpoint, to have any type of deduction to start, you need to have that for substantiation of the deduction. But most importantly, to take the disposition or to dispose of the item, you need to have separated those items out. And when separating things out, what a cost segregation does is it's measuring everything. So if I am measuring a new roof, the way you value assets inside of a cost segregation is through measurement and then applying a valuation, usually something like RS means, which is a construction tool. When assessing the value of a roof that's being disposed, those dimensions need to be understood and known, which would occur during the cost segregation process and separation process. Then the same RS means pricing and valuation methodology would be applied to determine the value and then provided that amount to take the expensed deduction.
Interesting. So, by the way, guys, Chris heads up a company that does cost segregation, CSA Partners, and I just want to say, can I put a link in the show notes for them to do a free analysis?
Absolutely. So
Okay.
this link, we simply need an address. We've been working with Anderson for many years, partnering with their tax team and their specialist over there to really just get very simple and basic information for individuals and investors out there to give you information well before an engagement, so you can see this is the right thing for me or not the right thing to me.
Okay, so somebody can use that link. And by the way, there's no cost to it. You don't have to be an Anderson client either. I'll just say that. This is for my YouTube channel, and no hiding of the ball here, guys. It's free. And you can see whether or not it makes sense. But you've got to do these studies so that you can get the value right on a deduction. Now, you don't necessarily have to do a study if you're like building a property and you know exactly what it costs. And Chris, I think you and I have had this conversation before. You don't have to do a study. It's just if you get audited, you'll lose if you don't have a study, right? It's like risk reward. But when you have the study, then you can be very aggressive, and it tends to save people money. And that's where I come in. I always look at it saying there's value and there's cost. And yeah, the cost might be cheaper to do it yourself, but the value is in having somebody who knows what they're doing guiding you so that you get way more than it costs you back. So I might actually cost myself money by doing things on the cheap. But you can go in there, get that done, and then you can see whether or not you can get some benefit. Maybe it's a partial asset disposition. But more importantly, I want to go back to the qualified improvement property, because I think we're talking about 100% deduction here. This is under the one big beautiful bill where they said, here's a huge deduction, folks, and we're just giving it to you, and nobody's talking about it. Like I follow a lot of tax people online, and I talk to professionals. This one's flying under the radar. Can you explain what it is and how it benefits somebody? And I just want to be specific. This is non-residential property, right? So this is what you would call commercial property. This is anybody who's doing improvement on something that's not a residence.
Correct. Well, so not long-term rentals. So if it is a residential property, but it's a short-term rental, that
Aha.
actually classifies as commercial. So for all of you out there that are watching this, we buy properties, and those properties they might be whole to start, they might be tenant ready, but they need improvements as the years go on, and some of them aren't ready. They need a massive modernizing of the kitchen, or who knows what else. Just to start, QIP, the QIP element of cost segregation and tax benefit for investors is out there not only to help grow the housing market and base for us as a country, which is an incentive that you want, but the QIP piece ensures that we're maintaining modern, livable, enjoyable, marketable assets that people might want to rent. So just to start, what we typically associate with buying a rental property. And I focus heavily on short-term rentals because of the volume of them, but this also applies to other commercial properties as well. But when you buy it and you segregate it right away, you get a tax benefit. And that's super helpful. That's where most people end up starting. Now, you might use that tax benefit to make this a better property. You might add elements to it. You might change things entirely and change the carpet, but you might also add non-structural walls and other elements inside of it to make it a better property. All of those things, if QIP didn't even exist, those can be segregated just like you did on the original purchase of the property. They go into the same buckets: 5-year, 7-year, and 15-year. What QIP does is it expands that universe of potential deductions to anything that is not structural, anything that is not part of an elevator or escalator unit, or anything that is not sorry, I went through my 3 things too quickly. Structural, the expansion of the property, or something tied to an elevator or to an escalator. If it is anything other than that, it gets to be qualified as QIP. So think paint. Think of those walls that are not structural that you might throw up there that if you were just doing a cost segregation, you wouldn't get. So they're really saying, please go in and beautify. Most of these things that are going to be inside the interior of the building are going to qualify for QIP and be eligible for 100% bonus.
I gotta drill in on this then. So let's say that I'm buying a property and I know I'm going to be doing some fix up, and I'm like, gosh, I know I'm going to be writing that thing off over 27 and a half years. Maybe I do a cost segregation study on some of it and get about 30% of it to where maybe I can write it off faster. Are you telling me that if I start off and make that property into an Airbnb or a VRBO. Then I can use qualified improvement property and write the whole improvement off so long as I meet that criteria.
Correct. And the only other criteria that you really need to meet with that short-term rental is that it was in service before. So it was something else prior to you buying it. So it was being used before you buy it, and then you make these improvements to it.
All right, let's say somebody bought a property in 2024.
Okay.
And they've been using it as a long-term rental, and then they say, hey, I really want to make it into an Airbnb. Could they make it into an Airbnb, then do a bunch of improvements, or could they do the improvements and then make it into an Airbnb? What is the secret sauce here? What advice would you give somebody who's thinking they're going to dump $50,000 into a property? How do they write off the most of that?
So timing here is important, and this also qualifies for partial asset dispositions. You want to have the property in service before making the improvements, because if you make the improvements prior, then those will just be added to the basis. So putting it into service allows for it to be going, and then the improvements happen post that. Then they will meet that qualification for QIP as so long as the other elements I described earlier. Same thing for partial asset dispositions. If you remove them before the property's in service, then it's really not disposing of it as the way you would expect post it being in service.
But if I'm in service, do I need to be the short-term rental before I do the improvements, or can I do this as a long-term rental as long as I'm going to make it into a short-term rental and then qualify?
So for QIP, you would need to have it be a short-term rental first. So it is a commercial asset. If it's a
then we need
long-term
to,
rental,
I want to put a line under this. So guys, if you have long-term rentals, you've had it for 5 years and you know you need to fix it up. Maybe you've had it for 10 years, or you're like me, you've got these things for 20 years. You've already written them off and you know there's not a lot of depreciation left, but you want to I need to put 100 grand into a property. I'm going to, maybe I'm going to do the roof, but I'm also going to fix it up really nice. What Chris is saying is make it into an Airbnb first, which means 7 days or less per unique guest, right? Or for each, yeah. So you can go look at some of my other videos when I talk about the Airbnb loophole, short-term rental loophole, and things like that. But it's 7 days or less average usage for a year. So if you have property, you may have to wait a year before you do the improvements. Make it into an Airbnb or half a year or whatever it is, but you got to qualify for that 7 days or less. Then you do that, boom, now I do the improvement. Chris, do I get to write the whole thing off if I do that?
The improvements that you're making. Once it is that short-term rental, it does go from a residential property to a commercial property, which makes it eligible for QIP. So yes, then you're able to take those improvements and those all get qualified for bonus. Now, if you're like, well, I don't want to go into a short-term rental because I don't like turning things every week, and still the improvements that you make on that property that's completely deducted can still be segregated in what's called an improvement study. So it doesn't require a site visit. It's really just a review of the budget and then taking all the assets that are being bought and qualifying them as 5, 7, and 15-year assets.
Can your staff guide them? Like if somebody's looking at doing this on a property, could they reach out to you via, again, I'll put a link in there, but is that something you could help them with?
Absolutely. And in something like that too, we would like to work with whoever's doing your taxes as well to walk through that, to look at what you've done as a long-term rental to date, and if you're going to be converting this to a commercial property. But yes, that'd be something we'd be happy to help with. But and we work in tandem with your tax professional as well.
Share this with your tax professional, guys. The world is big enough. A lot of people think that I'm out here and I'm just trying to steal everybody's accountant's business, right? I'm driving them all to Anderson. That is not what I'm doing. As I'm teaching and I'm sharing and I'm bringing in experts like Chris here. And if you have a good accountant, hug them, hold them, kiss them, make sure that you give them presents on the holidays and remember their birthday, because it's hard to find people that get this stuff. If you do, and they're willing to put some thought into some things, share this video with them and introduce them to Chris. That's because having somebody like that on your team is invaluable. I can say that because we do about 10,000 returns a year, and we do a lot of cost seg studies, and you save our clients hundreds of thousands of dollars. Sometimes each individually in a year. I've had a few where it's really pushing up there into the, and some it's over 7 figures.
Mm-hmm.
Share this with them. All right. So we have the turn a rental property into a non-residential by becoming an Airbnb or VRBO. And then you just have regular old commercial properties too. Like maybe it's a restaurant, maybe you're doing You're doing a retail establishment or your warehouse or whatnot. Is this something then that they could use too?
Those are typically the best candidates, not only for QIP and partial asset dispositions, just because of the sheer expense and the volume of assets that you see. Hotels are another one. Hotels typically require so much turning because people
Mhm.
wear hotels out.
Oh yeah.
Um, so yes, and so buying a hotel, making these. I mean, you're in a commercial situation. Those improvements are going to be QIP restaurants. One of the biggest things where I know it's being missed is we did a review for a portfolio of 30 malls. And those malls, you could see very easily inside that there was QIP happening that wasn't being taken because a cost segregation was done 5 years before. And you knew it was QIP because you saw the vendors that you all know. You saw like Lemon, Journeys, and you saw just 100,000, 100,000. All those things were improvements for those tenants that the landlord was paying for, and they were set. They were aging them at a 39-year rate and depreciating them straight line 39 years. Those are all QIP, all bonusable. And then the same thing, you see all these new HVACs, huge HVACs, like $150,000 units that are going on these big malls, and you never saw any got taken away. So right there, they're probably sitting on across all those malls millions of millions. This is over a 30-year period, millions of dollars in expenses that they should be disposing of those. And that's a big example, but our Airbnbs, our hotels, the Starbucks, the McDonald's that you might own, all of those they're happening at the same rate, just not the scale.
Yeah. And by the way, every dollar that you can write off this year, just look at your tax bracket and say, this is how much this is worth to me. And I could write it off over 39 years. You're giving them you're giving them an interest free loan is what you're doing. You're saying, here, government, have
Yeah.
access to my money. And, I'd rather have it now so I can deploy it and use it, especially with, inflation. They keep saying it's 3%.
Yeah, I mean, they're averaging all the things that cause inflation. I think the things that affect me the most, like my healthcare, my food, my house, my car, all of those things are like in the double digits, it seems like. So, yeah, I get, maybe bookmark inflation is only at 1.5%. That's bringing down the average, but everything else is high.
Yeah, it's real life versus what the government tells us. So yeah, and we know that it's not going down. They're going to have to print a lot of money. We're at $38 trillion in debt, and it's not going away. It's a huge line item on the federal government's expense. Its expense report. It's going to continue to be that way. We're not going backwards, so they're going to keep printing money, which means inflation is going to keep going. And any investor knows that. All of the investors are wise to it, which is why they're going heavily into assets because the U.S. dollar is just going.
Yeah, hard assets are where you want to be. And I think with bonus depreciation back and all these elements built for investors, all everybody watching this video right now, you guys are actually going to be the ones that create a lot of the wealth that helps pick us up out of this because you're going to buy these properties and immediately generate value when you do it. So
Yep.
yeah, it's exciting.
Now, so the one big beautiful bill, one of the things that happened with, I think it was January 19th, 2025, that's when the 100% bonus depreciation kicks in when you acquire, purchase, and put into service a new property. But qualified improvement property, what if I do the remodeling in the latter half of 2025, but I've owned the property for 3 years? Do I get to use the 100% on that?
You do. For those of you that did acquire property before that cutoff date, or yeah, it's a sad thing because you don't get the 100% bonus. But if you are buying a property that you're putting back into service, and you are making those improvements after that date, those improvements are eligible for a 100% bonus. So that is a great consolation, if you will, even though the property to start didn't get it, the improvements will.
And I think most accountants are missing that one. So the vast majority right now there's still a lot of confusion around it because it was a huge bill, and we don't have a lot of guidance. But that is one of those things where, yep, if you're working with folks that do this day in and day out, and by the way, Chris, how many cost segs have you guys done? Just to give
Uh,
it a
we're,
perspective.
we're at a run right now of about 4 or 5 thousand a year. So we had about 85 folks. This is all we do. But yeah, we're probably nearing the 50,000 mark at this point in time. It's grown a lot.
Yeah, and by the way, just to take some of the fear away, when people hear about these things and they see huge tax savings, they assume IRS scrutiny. Is that been your experience?
So the IRS will go in and take a look at things, but I found it's less than 0.1% of audits happen. And when they do, as long as you did everything right, audits are very easy. Because what's happening inside the IRS is they're trying to do as much as they can with as little resources as possible, and they're looking for a few specific things. And those are all things that we do right because we follow the law exactly, and the audit guide is exactly as it's laid out. If you didn't do it that way, then yeah, you should be worried because even if you don't, if you win the lottery and are selected, if you don't have these very basic things done the right way, then you do risk a clawback, which is the last thing anybody would want.
Well, Chris, I want to say I appreciate it. We're right around time. What I will do is put a couple of your other videos, at least one of them or two of them, up where I've worked with you, so people can understand what cost segregation is. You did a great one on I think it was, what is it, 1245 exchanges. People don't know what that is. In the real estate world and investing world, there's a lot of misinformation out there from the folks on TikTok and Instagram and stuff. And you really want to listen to people that do it and that are in a niche. So I don't do cost segs. I use them and I use them with my clients, but I don't do them. Who does? CSA Partners and Chris and his team. So I'll put some links there so people can learn more about you and also get a better understanding so they can see if they can keep more dollars in their pocket. And plus, if you have questions, put it in the comments. So Chris, you and your team have gone in and answered a lot of the questions from the previous. Are you guys able to get to them? Are you able to make that commitment here where you'll
Oh, yeah,
jump in?
absolutely. We'll respond, and if you are filling if you're filling out the form out for the link that Toby provides to, somebody will be reaching out to give you the information that you requested as well. So we will be on that and be available.
Perfect. Thanks, Chris. And guys, watch the next video that I put a link to see what Chris talks about for cost segregation.
Thank you, Toby.